Welcome back to the deep dive. Today, we're looking at a really interesting point for the crypto market. It's September 20th, 2025, and things feel, well, volatile.
Yeah, volatile is the word.
Ah,
You've got sources, pointing towards these huge bullish structural changes, maybe the biggest we've ever seen.
but at the same time,
At the same time, you've got analysts flashing these pretty serious warnings, saying this phase, this bull run, might be running a bit too hot.
it's definitely a market of contradictions. That's what we want to get into today, right? Synthesizing these different layers.
Exactly. We're talking central bank policy, specific new laws, institutional money, all hitting at once.
Yeah.
Creates this intense optimism, but also extreme turbulence.
Turbulence is definitely right. I mean, we saw Bitcoin hit that incredible high earlier this year. What was it?
$109,300 back in late January.
Right, $109,300. Then that sharp correction, but also a really strong recovery in May. So it's not if it's a bull market.
Now, the question now is how much risk is baked into this particular stage we're in?
Okay, so what's our mission here? How do we cut through the noise?
Well, I think we focus on the collision of three sort of key forces. There's the Federal Reserve's policy, there's this crucial stablecoin regulation coming, and then there's a big liquidity event looming.
Right, understand how those interact.
And you basically understand the current volatility.
Yeah. Okay, let's start with the big one. The Fed. They just cut interest rates September 17th. What does that do immediately?
Well, immediately, like in the first day or two, you often get short-term volatility. Markets sort of jitter as traders try to price it all in.
The longer term?
Longer term, it's pretty clear. Lower interest rates, that's like rocket fuel for risk assets. Money doesn't earn much sitting safe, so it looks for higher returns, higher risk.
Like Bitcoin.
Exactly like Bitcoin.
Yeah.
So that policy decision, it's pure growth fuel for this market, fundamentally.
Okay, so the money tap is open, but then there's the government side drawing up these new rules. You mentioned stablecoin regulation, the Genius Act.
Yeah, the Genius Act, that's the U.S. Treasury sorting out stable coins.
For anyone who hasn't tracked every detail, what's the core idea there?
Simply put, it's setting the rules of the road for stablecoins. The digital coins pegged to dollars or other fiat. Things like compliance, reserves, who's overseeing them.
And why is that such a big deal?
Because of the potential application. If you zoom out, the thinking is this kind of formal regulation could make stablecoins the actual backbone for money transfers, domestically, maybe even globally.
Wow, okay. So it takes them from a niche crypto thing
to a regulated, integrated financial tool. It de-risks them. And that's a huge, huge shift, tectonic shift, really.
Okay, tectonic shift potential. But then there's this other thing that could maybe pour cold water on things short term, the FTX liquidation.
Yes, September 30th. This was to start returning about $1.6 billion to creditors.
That's a lot of money hitting the system. How should people think about that? Good, bad?
It's a massive variable. It really creates a dual risk,
How so?
Well, on one hand, sources say a lot of those funds are coming back as cash or cash equivalents. Remember, they liquidated a lot of BTC and ETH earlier.
Okay.
So if those creditors, institutions, maybe early traders who've waited ages, just want their cash out or want to invest elsewhere.
You could see some serious selling pressure.
Intense selling pressure, yeah. Immediately.
But what's the other side? The boost theory.
Right. The boost theory is more about psychology. First, just seeing capital return successfully. Even from a disaster like FTX, it builds some confidence, right? It shows the system can work, recovery is possible. Second, you've got maybe retail creditors getting funds back. They might just turn around and reinvest it straight back into crypto, buying altcoins they like, maybe more BTC.
So it could go either way.
Exactly.
Yeah.
But that $1.6 billion number is so big. Those first few days after September 30th, definitely a key time to watch.
So loose money from the Fed, coming regulatory clarity with Genius, and this FTX liquidity shock hanging there. Okay, yeah, that mix explains the whiplash feel right now. Let's shift gears then. Look inside the crypto engine itself. Institutional adoption. That seems to be accelerating like crazy. We went from what? 1 or 2 public companies holding Bitcoin?
To over 75 now.
75. That's not just a trend. That feels like a structural change in how companies view Bitcoin.
It absolutely is. A shift in corporate treasury management. Bitcoin's being seen less as just a gamble, more as a legitimate store of value, a strategic reserve.
Yeah.
Especially, with inflation concerns or easy money policies.
And the infrastructure is catching up to support that.
For sure. You see things like BitGo filing for an IPO. That shows the plumbing, the security, the custody needed for big financial players is finally getting robust enough. It's maturing.
And speaking of maturity and access, This new wave of altcoin ETFs, that seems huge for the average investor. We're talking ETFs for XRP, DOGE, SOL, ADO.
Oh, it's critical. Absolutely critical.
Yeah.
Because it just blows the doors open on the addressable market.
Also,
Think about it. Wealth managers, pension funds, traditional institutions, they can now get exposure to these big altcoins through a regulated product, an ETF. They don't need a crypto wallet, don't need to deal with exchanges directly.
and the demand is there.
The initial volumes for these new ETFs have been really impressive. It suggests there was a lot of pent-up demand for this kind of regulated access, and now it's got a channel to flow through.
Okay, that makes sense. But here's a question then. If all this institutional money and confidence is flowing in, why is BTC dominance still relatively high, around 57.2%?
That's a great point.
Doesn't that suggest the smart money is still mostly sticking with Bitcoin, kind of hedging its bets rather than fully embracing the riskier alts?
It does confirm that, for now, Bitcoin is still the main gateway asset for a lot of that institutional capital. It's the first stop.
Fine.
But if we see that dominance metric start to drop, and drop significantly, that's the classic signal. That's what people call altcoin season.
Right, meaning investors feel confident enough to move capital out further on the risk curve.
That's exactly. Moving from the dominant, sort of safer asset into higher risk, potentially higher return tokens, it's like the ultimate confidence gauge for the whole ecosystem, beyond just Bitcoin's price.
Okay, gauging confidence. Let's zoom in on the immediate term, next 24-48 hours. Given the Fed news, the FTX deadline looming, what are the charts suggesting for Bitcoin?
Right now, BTC looks like it's in a bit of a holding pattern. Cautious. We expect it to probably trade sideways, maybe adjust slightly. Think $115,000 to $117,500 is a likely range.
But there's downside risk, too.
Definitely. You have to be aware of that. Classnode data, for instance, is flagging a possible move down towards $105,500 sometime this week.
Ouch.
Yeah, it just highlights those whiplash conditions, you know? Institutional interest is super high, but one big liquidation event or just profit-taking could trigger a really swift, sharp drop.
And what about Ethereum? ETH often leads the way for the broader alt market, right?
It does. And ETH has actually outperformed Bitcoin recently, percentage-wise. That's usually a strong sign for renewed altcoin interest.
I do.
Well, the interesting thing is the psychological resistance. ETH has really struggled to break decisively past its old all-time high from 2021, the $4,867 level.
Some money's flowing into alt, but maybe cautiously.
Seems like it.
Yeah.
There's still some hesitation at those major peak levels. Suggests investors are still worried about a potential correction, that fear is still palpable.
That hesitation really shows up in the fear and greed index too, doesn't it? Sitting right at 48, neutral.
Smack in the middle, exactly.
Yeah.
Neutral tells you the market's kind of waiting for a decisive push one way or the other. Maybe the FTX outcome, maybe just seeing sustained ETF inflows.
Before it commits to full greed or full fear.
Right. And, you know, the basic rule of thumb, extreme fear can be a buying opportunity. Extreme greed might signal a pullback is due. Neutral means, well, wait and see, wait for confirmation.
Okay, so in this waiting game, with the Genius Act clarity coming, who are the immediate winners and losers shaping up to be?
Well, the immediate beneficiaries look like altcoins directly tied to stablecoins and the smart contract platforms they run on. So think Solana, Cardano. They benefit straight away from that legal clarity.
Because regulated stablecoins will need their platforms.
Precisely. And then you also have things like, surprisingly, maybe DOGE getting attention because its dedicated ETF launch brings that kind of institutional visibility.
And who's feeling the pressure?
Probably the more unregulated, maybe niche DeFi projects. As capital finds clearer, de-risked paths in regulated assets or major platforms, it tends to flow away from the corners of DeFi that feel, you know, murkier or less defined legally.
Gotcha. Okay, let's pull back again. Look at the long game. Short term is turbulence. Long game seems to be about structural clarity. You mentioned the Genius Act for stablecoins, but isn't there also talk about a broader crypto market structure bill?
Yes, that's ongoing in the House. And the goal of that bill is absolutely vital long term.
Why is that?
Because right now, crypto firms often face huge legal uncertainty. Is this token a security under the SEC? Is it a commodity under the CFTC? It's blurry.
Create risk.
Massive legal risk. This market structure bill aims to draw clear lines, define who regulates what. That kind of future legal clarity is what truly enormous institutional funds need before they can commit capital without being paralyzed by potential lawsuits down the road.
So regulation providing a foundation. And this structural maturity is changing DeFi itself, isn't it? We're seeing things like MetaMask planning to integrate perpetual derivatives trading.
Yeah, that's a big step.
Why does something like perpetual derivatives signal maturity? It sounds complicated.
It's sophisticated. Perpetual derivatives are advanced financial tools. They let traders make leveraged bets on price direction without actually owning the asset or worrying about contract expiry dates.
Okay.
When DeFi platforms can reliably support that level of complex trading, especially if backed by regulated stablecoins, it shows the ecosystem is ready for serious institutional-grade activity. It's moving way beyond just simple lending or swapping.
And finally, on the long game, demand. Is this inflow, this accumulation, likely to keep going?
The signs point to yes. You have continuous buying from big players like MicroStrategy. You have serious discussions happening at national levels about strategic crypto reserves.
So a stable demand floor.
That's the idea. A rising stable demand floor over time. That helps absorb some of the short-term selling pressure we talked about.
Okay, let's wrap this deep dive with a crucial risk check. If there's one key warning listeners need to keep in mind right now, what is it?
I think the most important warning comes from analysts at Fidelity Digital Assets. They suggest the market might be in the final acceleration phase.
Final acceleration phase, what does that mean in plain English?
Think of it like a bullet train approaching the station. It's going incredibly fast. The ride can be really turbulent, lots of volatility, right before a final major surge, and then the stop.
So high risk, high potential reward, extremely volatile.
That's it, exactly. Manage the risk correctly, there's potential, but it's definitely smooth sailing.
So for someone trying to navigate this, what's the core strategy?
Given everything we've discussed, the Fed, regulation, adoption, the market seems more driven by these big policy and structural shifts than just retail hype right now. So the strategy has to involve keeping a diversified portfolio, yes, but really, really closely tracking regulatory news.
Okay, trapped regulation. If we had to boil it down even further, the two absolute essential things for listeners to monitor daily right now.
Number one, ETF flows. Keep a close eye on the inflows for the spot BTC ETFs and these new altcoin ETFs. Consistent positive flow is key. It confirms institutions are still buying in.
And number two,
On-chain data. Specifically, watch whether significant amounts of Bitcoin and Ethereum are being withdrawn from exchanges. That's usually bullish, means people are holding long-term.
versus flowing onto exchanges.
Right. Assets flowing onto exchanges often signals people are getting ready to sell, maybe ahead of big news or market moves. So withdrawals good, deposits potentially bearish.
Got it. ETF flows and on-chain movements. That brings us right back to where we started, doesn't it? This collision. Powerful macro forces like the Fed and the Genius Act.
Smashing into this rapid industry maturation, driven by the ETFs and the corporate adoption. It's a moment of just unprecedented change, really.
So what's the final provocative thought you want to leave people mulling over?
I think the biggest question, the one that stems directly from things like the Genius Act, is about the future structure of finance itself. If regulated stablecoins do become this global backbone for moving money, what happens to traditional banks? Do they just become the pipes, the rails that crypto transactions run on? Or do they manage to integrate stablecoin tech themselves, and the line between traditional finance and DeFi just gets completely blurred?
Integration versus becoming infrastructure.
Exactly. That decision, or how that plays out, could define the whole financial landscape for the next decade or more. That's the really deep structural shift to watch.
A huge question indeed. Well, thank you for helping us cut through some of the noise today on this deep dive. Remember to keep tracking those ETF flows and on-chain movements. We'll see you next time.